Suhas from Pune, India asks, you keep saying when the interests go up. What event will trigger the rise? Who controls the interest rates? If it's the Fed, then why couldn't they keep it low forever?
The reason that the Fed can't keep interest rates low forever is because the more money they print to keep interest rates low, the less the dollar is worth and the faster prices will rise. And ultimately, it's not going to do the government any good if it can borrow money cheaply if that money doesn't give any value, any purchasing power to the people they give it to. So that ultimately is going to stop the Fed from artificially suppressing interest rates, is going to be the bottom dropping out of the dollar. Because the way the Fed keeps interest rates from going up is by buying bonds at inflated prices. The Fed overpays for bonds so that the yield on those bonds is lower than it otherwise would be. But in order to do that, the Fed has to create money out of thin air. So now the money supply goes up, and now money has less value. And of course, the more money the Fed prints to buy bonds to keep interest rates down, the less attractive the dollar is, the less attractive those bonds are to any private holders. So now there's even more pressure to sell them. There's even more upward pressure on interest rates, which means the Fed has to print even more money to keep them artificially low. And eventually, it can't do it anymore. Either it has to let interest rates skyrocket and prevent the dollar from collapsing completely, or it continues to print to keep interest rates low as long as possible, and in the process completely destroys the dollar, and you have hyperinflation. And it's that threat of hyperinflation that ultimately will force the Fed's hand, and it will result in the big increase in rates.
Tim from Tampa, Florida asks, I've been reading The Real Crash, and I agree with the likelihood of tough economic times ahead in the United States. Do you think there are companies, such as life insurance companies, that might actually benefit from an economic crash?
You know, life insurance companies, depending on how their portfolios are constructed, if it's a collapse in the value of the dollar, which is what I am envisioning, then life insurance companies benefit in that when people die and they have to pay off the policies, they're paying them off with inflated dollars. Now, that assumes that they've invested that money in the stock market or in precious metals. If they've invested their money in government bonds, then it's 6 of one, half dozen of the other. Now, if you have big increases in interest rates, that could adversely affect a lot of insurance companies. If they own a lot of long-term, low-yielding bonds, they could take huge hits. So a lot of it depends on how it plays out, how long the government waits to raise rates, how much inflation there is between now and then, how the insurance companies have chosen to invest the premiums that they've collected. So there are all sorts of factors that are going to impact how various companies will survive or thrive in the environment that I foresee.
Brian from San Diego, California asks, besides gold, would you recommend owning any other commodities such as corn, gasoline, natural gas, etc.?
I mean, absolutely. I mean, it's hard to own those commodities in a physical form, like you can buy gold coins and store them in your basement. But you want to have exposure to agricultural commodities or industrial metals through your investments, through your stock investments, or through funds that hold these types of commodities. So again, for information on how to do that and how to get exposure to those kinds of commodities, talk to one of the brokers at Euro Pacific Capital.
Eric from Hoboken, New Jersey asks, why can't we get some type of move in miners? Even on some days when gold advances, miners are still under pressure.
Yeah, gold mining stocks are making new 52-week lows as I'm recording this video. I mean, even though the price of gold has barely dropped maybe 1 or 2% in the last few weeks, gold stocks are down as a group, I think 11 or 12%. So I think Wall Street is throwing these stocks out the window. Not only are some stocks at 52-week lows, they are at multi-year lows. Some of them are trading close to where they were at the depths of the 2008-09 financial crisis. It makes no sense. I think, in fact, the index, the gold index, the HUI, H-U-I, is trading at book value. I think it's trading at a historic low valuation. So Wall Street assumes that the gold price is going to collapse. I think that's because they don't understand the gold market, they don't understand the economy, they don't understand what's happening with the U.S., with the Federal Reserve. I think you have a giant mispricing. I think Wall Street doesn't appreciate the potential that these stocks have for the future. Now, part of the problem, though, for the gold stocks is that rather than benefiting from inflation like they should, they're actually suffering. They're a victim of inflation. Inflation is driving up the cost of mining dramatically. But because everybody believes there's no inflation, because the government says there's no inflation, nobody is buying gold as a hedge against inflation. At least not enough people are buying. And so inflation is making it very expensive to mine gold, but the price of gold for many companies is actually going up more slowly than the cost of getting it out of the ground. And of course, so it's not a very good business to be in right now. And so the stock prices reflect that poor environment. But what I'm looking at as an investor, I'm trying to see beyond the horizon to the future, where it's a very different environment, where we've had a huge increase in the price of gold, which I am expecting to happen, which will make gold mining much more lucrative than it is today. And I think gold stocks will be valued much higher at that point. And then eventually the psychology will turn. The people who don't understand why they should own gold will start buying it. And they'll start anticipating higher gold prices rather than lower gold prices. And when higher gold prices are factored in, discounted into the stock of a gold mining company, that means you're going to have the multiples rising. Right now, you have a lot of gold stocks that are trading at 9, 10 times earnings. I think in the future, not only will these gold stocks have much higher earnings than they do now, due to gold prices rising much faster than the cost of mining, but I think you might see these stocks trading at 20 times earnings or 25 times earnings, and therefore you're going to have more earnings and higher multiples, and I think you'll have much, much higher gold prices. In the meantime, I don't know where the bottom is, but I think that we're a lot closer to the bottom than the top for sure, and so I think you want to buy. I can't promise you when it's going to turn around, but I'm very confident that if you're patient, I think you'll make a lot of money. But again, you got to understand the risks, and also it's possible that I'm wrong, right? And maybe if you're patient, you'll just lose even more money. You've got to decide for yourself the way to go. And again, there are gold stocks that I prefer. I have my favorites. Talk to a broker at Euro Pacific Capital, find out what those stocks are, and find out if they're suitable for you.
Doug from Winter Springs, Florida asks, in a recent Schiff Report video blog, Debt Ceiling and the Fiscal Cliff, you said, get out of any debt denominated in dollars. I intended on letting inflation ease my low-interest debt while making better investment choices with the money I have. However, your comment in the video makes me think I am misunderstanding something.
Yeah, you are misunderstanding me. I'm not talking about getting out of the debt that you owe. I'm talking about getting out of the debt that is owed to you. So when I talk about getting out of dollar-denominated debt, that means if you own a bond, or you own the mortgage, you're the bank, or you've loaned somebody money to buy a house, you don't want to own that asset. You don't want to own that mortgage. You don't want to own that bond, because inflation is going to destroy the value. On the opposite side, that's where you are. You have borrowed money in dollars, so you don't own the loan. You're the one that's obligated to make the payments. You're in the catbird seat as far as I'm concerned when it comes to inflation. So you don't have to get out of debt. I mean, you want to take on dollar-denominated debt. You just don't want to own it. You want to be the borrower. You don't want to be the lender, because the borrower gets to repay the lender in money that has less value than the money that he borrowed. The only thing that I caution people about is make sure to get a fixed rate, because it is possible that the Fed could really do the right thing. I don't know how to put a probability on it, and really jack up interest rates dramatically, and people that have debt where they don't have the low rate locked in, they could be in for a world of hurt if you get a big spike up in interest rates and they can't afford to make the payments. They might have to sell some of the assets that they bought with the borrowed money, and of course if other people are having to make the same trade, those asset prices will be collapsing. So I think the most prudent way to bet on inflation as a debtor is to do it by locking in these artificially low interest rates. So at least if you do have a spike in interest rates, that won't affect your cost of financing your debt, because you've locked it in.